Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about something a little bit different, and it's not a technical video, but I will say this video will probably save you way more money in retirement than any of the other videos have done. And it's about what to do when the market's a little crazy, when the headlines in the news are a little crazy and they cause you to panic a little bit. You know, we've been with clients through 2008, 2011, 2015, 2018, and 2020. And I can say firsthand that in the summer of 2020, we received a ton of phone calls, not from our current clients, but from people that were looking to change advisors or just looking for a new place to work with. And the conversation I had with a lot of them was, we sold out when the market dropped in March of 2020. And it derailed their financial and retirement plan exponentially. Now, a lot of them we've gotten back on track to some extent. We're trying to kind of play catch up at this point. But when the headlines scream fear, naturally, we want to pull back. We want to get our money out of the market. We want to do something irrational that goes against what our financial and retirement plan says we should be doing. So when I turned on my computer this morning, I always go to Yahoo Finance. And of course, the NASDAQ is down over 20% now. So now we're in a bear market on the NASDAQ. The S&P 500 is down over 10%. So we're in correction mode there. In Canada, the TSX is actually holding strong. We're actually almost at near 1-year highs here. So it's kind of ticking along and doing okay here. And maybe that continues with the recent oil surge. But with the NASDAQ, the S&P 500 and Dow, we're down quite substantially. And so that drives headlines. And a lot of the headlines we get here in Canada are driven from the markets in the States. Because what are the headlines here? Market's down, market's down. Well, take a look at the graph of the TSX. It's not down. And this goes on both sides. When the market's bad, I think you have to be careful what you read. And I think when the market's really good, you have to be careful what you read. So if you're only going to one news source for your information, start spreading that out a bit. Get the other side of the coin. And I think that's going to give you a bit of a more broad perspective on what is actually going on in the market. Now, obviously, there's a lot going on in the world right now, especially with the Russia-Ukraine war going on. So the geopolitical pressures are massive. The sanctions that are coming in. The US just banned Russian oil imports as of today. Now, that's only about 8% of petroleum products in the US, so it's not a massive number, but it's a big stance, and that's a trickle-down effect. And as the North America and the rest of the world cuts off Russia, Russia spends money. I was looking at some data this morning. Big companies like Nike, H&M, that do a lot of revenue in Russia. So there's going to be a bit of a trickle-down effect, no doubt. And of course, you can't notice but the inflation. I mean, we've been hit with inflation for the last year and a half, and it seems to never be ending. And now gas prices. If you filled up your car with fuel in the last week, you've noticed gas prices are up 10-15%. So everything around us seems to be kind of crumbling, and it's bad news. It's bad news. So I want to go through your financial retirement plan. If you're close to retirement, in retirement, maybe you're years away. It doesn't really matter. What is your plan? We're exactly 2 years away from March 2020. Are we going through the same thing? I don't know if we are. No one has a crystal ball, but I want to always go back to your financial plan. Now, what I want to look at is the RRSP meltdown. Okay, so if we look at capital assets here in the middle, you can see this client has a plan to pull out $30,000 out of their RIF. So they have about $300,000 total in their RIF. This year, they're pulling out $30,000. In their TFSA, they're pulling about $5,000, $4,500 out of their $100,000. So 4.5% of their TFSA they're pulling out, and about 10% of their RIF. If I go over to Mrs. YouTube, she has about the same thing, $30,000 and $4,500. So 10% and 4.5%. So over the next year, you need to pull out $30,000. In 2023, the plan is to pull out another $30,000. So if you have a dividend portfolio that gives you 5%, half of my income from my RIF is going to be paid in dividends. The other 5%, or in this case $15,000, I need to raise cash. I'm going to need cash. The rest of it is growing long term. If you're preparing for 2 years, maybe you grab another $15,000 and put it in cash, or a 1-year GIC, or whatever you want to do with that. But that's kind of how I look at planning for retirement. What do I need this year and next year? I typically look at 2 years. If you're more conservative, maybe you grab 3 years of income. But I can tell you firsthand that the people that got 100% out of the market in March 2020 because they panicked, they're in a worse off position. You can never time the market out, and you can never time the market coming in. What you can time is your financial plan, your retirement plan, how much income that you need. So in this case, $300,000, let's say I need $90,000 over the next 3 years. I'm going to take the other $210 and just Leave it in the investments that they're in. It can ride through the market wave. If we do have a bit of correction, what happens if we take a little dip and then bounce up and you pulled out of the market? You're missing that. So if you're working with a portfolio manager or someone that manages your money, go through your retirement plan, your income plan with them so they understand what you need and what they can set aside, so that if we do have a bit of a market correction, it doesn't derail your cash flow. So when we go through and we've created this financial plan and $30,000 a year, then it drops to 20 when CPP kicks in, that's a tax plan. And it's very important to follow a tax plan. I had a client call me the other day and said, you know, Adam, I'm a little worried about the markets and I think I'm just going to not touch my RIF this year and I'll pull double the amount next year. I had to go through the process of, it doesn't really work that way. We want to level out that tax bill. We could always pull money out of the RIF and move it to a non-reg and not actually sell the stock. But again, that doesn't meet your cash flow needs. So look at your cash flow needs and then plan forward from there. So when the headlines in the news are bad and you're not sure what to do, I think you always have two options. You panic and pull out, or you go back to your plan and follow the plan. It's going to all depend on your situation, your cash flow needs, your lifestyle, your risk tolerance. But typically, if your plan is to fully pull out of the market, then that's okay. If that's your decision, that's your decision. Have a plan to get back in the market, whether it's a certain price point on the NASDAQ or Dow or S&P or interest rates or inflation. There has to be a trigger to get back in the market. Because as you know, inflation's 4 or 5% right now. If you pull out of the market and you're sitting in cash, you're getting 1%, maybe a bit less, maybe a hair more. That's not a good long-term solution either. So I'm not an investment manager. I'm not saying be invested, don't be invested. No one has a crystal ball. No one can tell you that. But if you have a clear retirement plan and you follow the cash flow plan within the plan, then you should be okay. Hopefully that helps you. Hopefully it saves you from doing something crazy and irrational. And we'll see you in the next video.